Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Services. Listeners, if you'd like more information about what you hear on this great show today, please go to our website at jonesfinancialtalk.com. Lots of great information on there. Tony, my co-host, loves the radio page for lots of reasons, as you can imagine.
Yes.
But you can subscribe to this great program on Apple Podcasts and Spotify and Amazon Music if you'd prefer. And you can also ask any questions that you'd like for us to cover in these shows on a weekly basis. Last week, we actually had a couple of callers and clients ask me to talk about the great wealth transfer. Baby boomers obviously are getting a little older, and as they do, they're going to be handing off just trillions of dollars to their kids and grandkids. And
That's right.
so during the show today, I thought it would be helpful to talk about ways to discuss, how you can hand off those assets, effectively and maybe in a more tax efficient way. So, Tony, how are you doing today, buddy?
I am doing great, Nick. Great to be here with you. I'm excited about today's show. This is something that I've been involved in somewhat. My grandfather passed, left some farmland and some things to my dad. We're working with my mom and dad because they're not in the best health, meeting with attorneys and things to transfer that, talking to financial advisors such as yourself to make sure that we're taken care of. And my wife and I have been trying to lay out our plan if something should happen to us. So transferring wealth to your kids is even harder than people might imagine, I think.
It is. I mean, actually, in the last year, Tony, I'd say this is almost the number one topic, other than market volatility, that I've covered with clients. And
Sure.
we've put together just a great enhanced planning kind of pamphlet and information that I'd be happy to share with anybody that's listening to the show. The point is, education is key, and you have to understand different options that you have before you make any of these decisions. Clearly,
Yeah, and Nick, you mentioned enhanced planning right there. And I want to define that for our listeners out there. That's basically enhanced planning is taking your overall financial picture, but then creating as part of that plan a plan to leave your legacy. That includes estate planning, wills, trusts, those types of things, strategies for transferring your wealth to your kids. That's what enhanced planning is, right?
you got it. And I'm going to talk about some of those specifics and maybe the things that you should be talking to your financial advisor or your attorneys or legal counsel about to make sure that that's all set up later in the show, also, Tony. And we're going to talk about some specifics about how you can, you know, use that in enhanced planning information to be able to be efficient in the way that you're transferring these assets, like we've discussed.
Yeah. Yeah, I think that makes sense. That's smart. Obviously, as a parent, I want to help my kids. College is a part of that. College costs. What can we do to help out with that? What can I do to help make things easier if something should happen to me? Those are all part of it, aren't they?
They sure are. And, depending on what your initial goals are and then long-term goals for the transfer of this wealth, that's going to help determine the route you want to take and how you're going to organize things. And it's never too late. It's easy to make these changes, but you just have to make sure that you understand what you're trying to accomplish and why you're making these changes. And Tony, I'll note one thing here also. you know, in the last 5 years, there's been so many different changes from a tax perspective about inheritance. And so if you're not up to speed on the different tax laws, you could be missing out on some extremely important planning steps that you should be thinking about. And we'll talk through some of those as well.
Yeah. Yeah. And I know you and I were talking about this Kiplinger article, Three Ways Parents Can Transfer Wealth to Help Their Kids. We're going to talk a little bit about that. And some of the information we're going to discuss is from that. I just wanted to note that. But it really is, there's a lot to this. There's a lot you can do for your kids out there. Where do you want to begin?
Okay, so probably the most basic type of scenario that most people consider are what are called custodial accounts. There's two main different types of custodial accounts, and people probably that are listening have heard of UTMAs and UGMAs. Those stand for Uniform Transfer to Minors Act and Uniform Gift to Minors Act. And
Ah,
think of this as just a shell, Tony, that you as the custodian can hold assets in for somebody that's under the age of 18 or 25, depending on the state that you're in. 18 or 21, I should have said. And inside these accounts, you can hold investments. A lot of times, parents set these types of accounts up for their children when they receive money for birthdays or for holidays or maybe for working. And the point with these accounts, Tony, is whoever is the custodian of the account is the one that controls all the assets until the child reaches a certain age. And depending on your state, that usually is 18 or 21.
okay. So that's interesting. So custodial accounts are one way to do this. And a custodian is named then on the account to control all its assets. And that's especially for kids who are minors, right?
That's right. And then when the child becomes age of majority, like I mentioned, you say either 18 or 21, legal control falls to the child inside that type of an account. Taxes fall into to that as well for them. And so, you have to understand if you're setting these types of accounts up that eventually the child is the one who's going to have complete control over the assets that sit inside that account. Okay.
Sure. Yeah. And that makes sense. I think that it's important to understand this. It sounds like we're already getting deep in the weeds, and I'm already thinking, wow, a lot of our listeners out there or viewers might be thinking, I'm going to need some help with this, right?
Well, and I would say that that is the most basic type of account that you can set up for a minor in a way that you can gift money to somebody.
Sure.
But there are some complications with that. The biggest thing is control at a young age. And so there's lots of other ways to accomplish this. But what I mean by that is think about if you gave lots of money to a child in a custodial account, and then at the age of 18, they have access to tons of money. Is that the
Yeah.
right thing? Is really the question. And so you have to make sure you plan this properly. It's great that we have these types of tools to use to be able to move money from your own estate to a child or a grandchild, but you have to understand the control situation. And so the reason why I bring that up, Tony, is there's other ways. A trust or a limited liability company or a limited partnership, for instance, are other ways that you can transfer, these types of assets to a child instead of just directly giving it to them. And there's lots of benefits to using those types of options as well.
Yeah. Yeah, and I think that makes perfect sense. So I know we talked with an estate planning attorney, my wife and I did, about trusts, both for my parents setting it up with my dad's, and then myself uh, as well. So it's a little easier for me, Nick, because I'm an only child. So
Sure.
that helps. But in one sense, it helps. In another sense, there are other things where it's a huge disadvantage. Like my parents are needing care right now, and it's just me, right?
Yes,
And so,
definitely.
yeah,
Well, and so everybody's situation is a little different. Personally, I have a 14 and 16-year-old, and my wife and I created a trust a couple of years ago for the simple fact that if something were to happen to us, how do the children that are not even the age of majority have the ability to continue living the way that they should be able to based on what my wife and I have accumulated asset wise. And so that's a very specific reason why you would want to trust.
yeah,
And people that are listening might say, well, I'm older than that. I don't need that for my grandchildren, but you may, right? If you are trying to bypass gifting strategies to give your grandchildren some things, that might be something that you need to consider. And so there's very effective ways to do that that will allow you to kind of dictate, if you passed away, how you want those beneficiaries to utilize the assets. That's the whole point here. It's control. If you're going to use something like a trust or a limited liability company or a limited partnership to accomplish these goals.
sure. And another reason you would use a trust, right, is because of tax reasons
Definitely.
and long-term care issues. I know that I wish my grandfather had set up a trust because of the way it worked, because my mom is in long-term care and my mom and dad didn't really have anything. So she's partly helped by the state, but now my dad has inherited this
Yep.
land and money that's worth something. And so there are ways to protect inheritance from certain taxes and certain, not all, but certain people can really make mistakes that can be hugely costly. Like the initial CPA told my dad and his 3 siblings that all my grandfather's land and all his assets and the tractors, everything was worth, this big sum of money that they estimated at. So then they just filled out the standard Minnesota state tax form for that inheritance and said, you collectively owe $225,000.
Isn't that crazy? So Minnesota and Oregon are 2 of the worst taxation states for estate taxes. It's crazy.
They said you owe $225,000. I said, because I've worked with you and financial professionals, I said, hold up. That cannot be correct, because they're not selling the land. They didn't inherit cash. None of it is liquid. And it's a family farm that's been in the family since it was homesteaded, and they plan on, my dad lives there,
right?
And it's still being farmed by them. So
I'm glad you had a little bit of knowledge in that situation. That could have been a tax bill that was clearly not warranted. Right?
And guess what? All they have to do is sign a form that says they won't sell any of it for 3 years, and they have to update that every year.
Yep.
And sign that form and send it in, no tax.
Well, and so that's the beauty. That's the beauty of proper planning and a trust. And
yes,
Tony,
exactly,
that's a perfect real world example. But for our listeners out there, that may be thinking about ways that this will help them, everybody's heard of a trust fund, right? And if you use a trust fund in the right way to purchase assets on behalf of a child or a grandchild, the benefits can be that they don't actually own those assets necessarily. And so if they never need to use that money that's inside the trust, it can pass on to their heirs. Right. So we're talking about legacy planning here, right? You want to be able to provide the people that you love and the people that the benefits of being able to use your assets. But if they don't use them during their lifetime, after their life, do you want that just to end and then a huge tax bill to come? Or if you structure it correctly, maybe that doesn't have to happen. And their heirs, their children, now have the benefit of being able to utilize those assets that you put away for them. Right. That is extremely important. And it's hugely beneficial when you're thinking about legacy planning, right?
Right. Well, and I have an example of a friend of mine had a relative that she was older and had about $650,000 in her. She had saved up for retirement, but she's 86, right?
Okay.
But she's in long-term care, starting to need some memory care.
Yep.
She's in a nice private facility. It's she was at like $6,000 a month. If she goes full-time memory care, it'll be $12,000 a month. Well, she wanted her children and mainly her grandchildren to get some of that money. But what's happening is it's being eaten down by that.
Wow, the cost.
But if she had worked with someone like you alongside the estate planning attorneys that you work with at Jones and Associates, she could have set up, there's that 5-year look back period, and every state's a little different.
Medicaid, you're exactly right.
In Minnesota, they could have protected that money from just all going to long-term care. The state and Medicaid could have covered that. Long-term care, and that money could have went to her kids and grandkids. Right?
Exactly. Yeah, there's lots of little tools and ways that you can, for your specific situation, figure out the strategy that fits for sure. And there's other things that we're going to talk about during the show. I'll give you an example of ways that you can accomplish these things in a much more efficient manner. So if you directly fund a child's educational or medical expenses rather than just giving them the money, that is hugely beneficial for estate taxes as well and gift taxing, because the IRS does have things, in their code that are going to help us in these situations. So the qualified transfer rule, for instance, allows us to direct payments for a child's well-being, whether it be educational or medical, to to be able to go to help pay for those things without giving the money directly to them. And in some situations, that's excluded from both federal and state estate taxes and gift tax rules.
Wow.
And so if you know those things going into the way that you're going to plan things, and you know those things are going to come up throughout your life, if you have that conversation before you make that decision, it's going to be a benefit, clearly.
So if you want to leave money or for your kids for college, and that money, there are ways to put it like directly into a 529 plan or something else for them, rather than give them money and have them pay the bill. You pay the bills to the university directly or through a 529. Is that what you're saying?
Yeah, so two different things here. So the qualified transfer rule is when you pay the school directly so that it
Sure.
avoids estate tax and gift tax issues.
Okay.
The second that you just brought up, which is a very, very important, pardon me for a second, Tony, is the 529 plan.
Sure.
And the way that the 529 plans are designed is if you put money inside a 529 plan, the benefits of that are that all of the growth inside the plan is not taxed as long as you use it for qualified expenses to the university. And that is a very broad term, and it's continuing to increase in different things that you can utilize with those types of accounts. The idea is when you go and remove the income from those types of accounts, if you use it for something that the IRS dictates is qualified, you don't have to pay federal or state taxes on any of the gains. And so a perfect example, let's say you save $10,000 when your grandchild is born. And just on a simple calculation, let's say that the money gets 7% return and doubles every 10 years.
Mhm.
You go from 10,000 to 20,000 to $40,000 inside of 401k. I'm sorry, inside of 529 at the age when they're going to use it for school, right? Well, the $30,000 in gain that you've made there is not taxable in that situation as long as you use it for qualified educational expenses. And those types of expenses are very easy to use if the child goes to school. The main thing here is the child is the beneficiary of the account. You get the tax break from all of the gains if you're utilizing it for the correct things, like we mentioned, but the child is not the owner of the account. And so why is that important? What if the child decides not to go to school? Or what if you want to share that account with somebody else later? You have the ability to still do that in the same manner and still reserve all of those tax gains that you would have otherwise paid because you decided to use this specific type of account. And
Yeah,
so,
like my middle daughter got our middle child, my daughter got a full ride scholarship to college.
yep,
So we were very excited about that. But she had the largest amount in her 529 that we'd put in and that had built up. So we're now able to use that money for our youngest child's
that's
college
right.
education because it's not limited to just that person.
Sure thing. And here's the other thing. I have a client locally that has been saving a lot in their 529 plan for their kids as well. And one of them got a scholarship to go play baseball. And they're not going to utilize the 529 money today because of that. However, they could wait and use it for, say, a master's degree if they decide to do that. They could pass it on to one of their other children, like you mentioned. They could pass it on to one of their grandchildren eventually. Or if you remember from some of the planning shows that we talked about earlier in the year, you actually have the ability now to transfer some of that money even into a Roth IRA for the child in the future. So the point is there's lots of flexibility in ways that you're able to transfer wealth to people. If you use these different techniques correctly for your specific situation, you're going to come out way ahead.
Yeah. Yeah, and that's huge to understand, that, 529s, I think that's a really important thing. So obviously, taxes play a part in all of this. That's the main point. Otherwise, transferring wealth to your kids would be super easy, right?
That's right.
But
That's
but
right.
there are so many tax laws and regulations. That's why we're having this discussion, because you need strategies to minimize that tax burden and not make costly mistakes. And that's why I'm going to let our listeners know right now, if they have questions about this, you are more than happy to meet with them, you and your staff, and that consultation. They can get a no charge, no obligation consultation. All it's going to cost you is your time. And all they have to do to get that is call this number and mention that they heard about it on the radio show or the video show. It's 541 773 9567. That's 541 773 9567. Or just go to the website, even more importantly, jonesfinancialtalk.com. That's the easiest way. Just go to jonesfinancialtalk.com. You can listen to this show. You can listen to past shows. You can subscribe to the show as a podcast on all the major podcasting sites, or listen right there on the website. But there's links to everything there. There's a contact form. So get a hold of Nick and his team through jonesfinancialtalk.com. Now, moving on, what's something else we need to know about strategies for transferring our wealth to our children?
So the other thing that has recently come up for me personally, because my kids are 14 and 16, is starting either a traditional or a Roth IRA for the child. And this is
Okay.
totally doable, especially if the child has any type of earned income. And so the IRS treats this the same as you. You have the ability to save for a minor, okay, money in a Roth IRA or a traditional IRA, which we've talked about before, if they have earned income. And so a traditional IRA, as many of you know, is where you get the tax break up front and the money grows tax free while it's in the account. And then you pay taxes when it comes out. A Roth, on the other hand, is where you don't get the tax break up front, which in this case, most of the minors wouldn't, and maybe you wouldn't either. The money does grow tax free, but then when they take it out later in life, they never pay taxes on it. And the real thing to think about here is when you compound money over many, many decades, the benefit of that is astronomical. And so
Yeah.
if you can start a Roth IRA for a grandchild or for your child when they are, 15, 16, 18 years old, and they understand that that money is sitting there for them long term for retirement, and it grows for 40 years before they use it, you can imagine how big those balances get, Tony.
Yeah.
It's one of the best planning tools and ways for you to help save for them later. And so I'm a huge believer in the Roth IRA for children, and I think that if they work and have earned income, it's just a very, very natural, easy thing for a grandparent or a parent to do to help them out. It's enticing too. You say, look, you go out and you make some money this year. Say you make $5,000 working at the golf course, right? You keep the money, but guess what? We're going to put money into a Roth IRA or a traditional IRA for you because you've made
Right.
that much money, and you're going to have the benefit of that money being able to grow for decades, like I said, without paying any taxes on it.
That's huge.
That's a simple planning tool that so many people fail to understand that they can utilize. And it's just really, really easy to do that in many situations.
Well, yeah, and we've talked a lot about Roth IRAs and IRAs on the show before, but those tax benefits and strategies, that's great. And utilizing a Roth for your kids, that's a really smart move the way it sounds. So what's another way that we need to be thinking about in order to transfer wealth?
So, one thing I think it's important to talk about is making sure that you do that enhanced planning like we talked about. Because if you don't, you could get into some issues with some of this gifting. I mean, it's estimated, Tony, that somewhere around $85 trillion is going to be passed down from baby boomers to the next generation through 2045. 85
Wow.
trillion. Okay. And so,
$85 trillion.
right.
That
And
could
what do
wipe
you,
out the national debt.
well, and that's the point, right? If you don't do this correctly, how much of that money goes to taxes,
Yeah,
right?
a lot.
One thing that I often talk about when people bring up the idea of gifting and helping other generations is you got to make sure that you have, significant assets for yourself to continue to cover any of those things that you might have to pay for, like your mom's care, for instance. If you transfer all of your wealth to your child, and then you need some of that for care because Medicaid won't kick in for whatever reason, or you don't have a long-term care policy, you could be putting yourself at a huge disadvantage. And a lot of times this is not because of something that your child does, but think about things in life that can happen that change financial situations drastically. The
Yeah.
number one that comes to mind for me, Tony, is divorce. Okay, so if you transfer the majority of your wealth to your kids while you're living, say in your 70s and 80s, and then you need some of that money to help with long-term care services later in life, or your house or something like this, and they're married and then they get a divorce, that could really complicate things.
Yeah.
Well, I mean, what if their ex-husband or ex-wife ends up with lots of your assets as a result of being married during the time that you gave it to them?
Hmm.
Right. And so
Yeah.
these things and topics come up all the time. I this might be the number one thing that we talk with our clients about with their legal experts on the phone,
Sure.
figuring out how to effectively gift in an appropriate manner, but also protect yourself. So that I think I just really, really wanted to hammer home so that people understand it's not just as easy as saying, okay, I'm going to give you this, I'm going to give you that. If you do it at the wrong time or for the wrong reason or in the wrong situation, or don't use enhanced planning to be able to do it effectively, you're going to get burned, or you could,
Yeah.
unfortunately.
Yeah. Yeah, and that's huge. Obviously, you want to make sure you're working with a financial services professional, a financial advisor who's looking out for your best interests and working alongside tax professionals and estate planning attorneys. But really, all of this ties into family harmony too. That's another thing you want to protect when it comes to giving assets. I've seen it divide the tightest knit of families in
Sure.
from my own personal situation with my grandfather's passing. A family I never thought would ever have any issues, tight knit. It's amazing what can that when it comes to the transfer of, family heirlooms and land and things like that. People get crazy. I mean, and to keep that family harmony, that's got to be part of the strategy too, right?
Of course, and if you already know going into it that maybe siblings or other family members aren't going to get along, if you organize and dictate your thoughts through a trust or some other planning tool like we've talked about on the show today before you pass, it's in black and white, and it is what it is, as they
Yeah.
say. And so you are exactly correct. It's so important for everything to be utilized the way that you want it to be and constructed and use that strategy. Now, the other thing is this: you got to act on it after you create those plans.
Mhm.
And so when you meet with an attorney and build a trust, for instance, a simple thing is, okay, great, I have a trust. But if you don't put everything that you own in the title of that trust, then none of it matters. Right. So
Right.
you have to follow through and have some actionable items that you're definitely going to work on after you build the trust. Inside a trust, we've talked about this before, but estate planning and enhanced planning has so many different little pieces. You've got the trust, you've got which kind of dictates like what you want to have happen, and if you build a trust, it will usually avoid probate, so you don't have to worry about a judge determining what's going to happen. And then the will is an important part of that document as well. Also, one thing I wanted to mention before the end of the show is huge parts of enhanced planning and everything we've talked about are two main things, right? Power of attorney for both a financial situation and a healthcare directive. And so if you don't have those things before something happens to you, who's going to be able to make the decisions that you've worked so hard for that we've talked about on the show
Right.
if you can't do it for yourself, And then
Yeah.
the other big thing, and this is hugely dependent on the state you live in. And Tony, in Minnesota where you live and in Oregon where I live, this is a huge deal because of estate taxes. The way that you title assets is incredibly important. And so there's lots of different ways that you can effectively title your assets to get them to transfer the way that you want. And think
Right.
about this, listeners. In the state of Oregon, we have the lowest threshold for estate taxation. It starts at $1 million in assets. If you have more than $1 million in assets and you live in the state of Oregon, you may and probably will be subject to estate taxes. And if you
Wow.
don't plan for all the assets that you own, that's a huge tax bill like Tony's talking about. Then that $250,000 tax bill, if you have, say, 2 million or 3 million in total assets, is a reality. It
Yeah,
really is a
yeah,
reality.
it
And
is.
so you got to think through that. A lot of people say, well, you know what? I'll let my heirs think about that and deal with it when I pass away. But what if you could effectively change that with just a couple of very basic planning tools before you pass away?
Yeah.
That's the
Yeah, you
point.
don't wanna leave your loved ones, Nick, in a bad situation, and we've gotta wrap up the show now, but before we do, Nick, let our listeners know about that web address that they can go to contact you and set up that consultation.
Good deal, Tony. Yep. If you just go to jonesfinancialtalk.com, you can ask any questions you want. We've got great enhanced planning tools that we can utilize and share with you. I just urge you to go there, jonesfinancialtalk.com.
All right, well, thank you, Nick, and listeners, thanks for tuning in. That does it for today's episode of Jones Financial Talk.